This video is going to introduce you to the basic concepts in investing and trading in the financial markets. It is best suited for viewers with no prior formal financial education. However, if you have some financial background, you can still watch it because the video might serve as a quick review to refresh the understanding of the financial market. But before that, we welcome you to the Wealth Moguls, the largest YouTube channel where you can find everything about finance. If you're new here, hit subscribe and click the notification bell to be notified of new videos. We'll be presenting interesting information about investing and trading in financial markets. So, let's get started on our topic. Two runners register for a race. One runs to the finish line at a steady, comfortable pace. The other alternates between running bursts and walking periods. It's tough to predict who will win, just as it's difficult to predict which technique, trading versus investing, will put investors on top. Trading and long-term investing are two methods to investing money in the stock market to earn profits, just as sprinting and jogging are two types of running. However, even though the terms are sometimes used interchangeably, trading and investing are very different methods. Trading is associated with short-term purchasing and selling, whereas investing is associated with buying and holding stocks for an extended period of time. Depending on the level of market expertise and the amount of time you have to spend on market performance, neither of these approaches is inherently better or worse than the other. Learn more about trading and investing so you can determine which strategy is best for you. Let's start with trading. Trading is all about making short-term transactions with the intention of beating the market or earning higher returns than you would expect from buying and holding for a longer period of time. Whereas long-term investors may want for a 7% annual return, a trading goal may be 5% gain every month. In trading, the short term can range from immediate transactions such as purchasing and selling a stock within minutes to transactions that take weeks or months. Traders purchase and sell stocks, commodities, forex, and other easily liquidated securities. The holding period is a time frame between purchasing and selling a security. Traders are characterized by their trading technique and the duration they normally hold their securities. A position trader keeps securities for months or years at a time. Swing trading entails holding shares for several days or weeks. A day trader will hold security during the day but not overnight. Scalp traders hold shares only for a few seconds or minutes. What's behind trading methodology? Let's see. When trading, the phrase buy low, sell high is frequently used, as traders strive to generate a profit in a short interval of time by attentively monitoring market swings. Furthermore, active traders frequently use technical analysis to research stocks and forecast patterns in stock price variations. This means focusing on a stock's technical characteristics rather than the company's long-term prospective earnings or broader economic trends. Another typical trading method is short selling, which is the inverse of the word we just said. Short selling a stock means selling borrowed shares at a high price and then buying them back later for a lower price, generating a profit through the difference in prices. Limit and stop traders frequently use orders to help predict the cost of buying or selling stocks. A limit order, for example, can ensure that a stock is only bought or sold if the price reaches a specific point or better from the trader's perspective when the order is placed. A sell-stop order can trigger a stock sale if its price reaches a specified point below the current price. Similarly, a stop-loss order will trigger security to be liquidated if the price falls below a specific amount but stays above another specified amount. These orders provide traders with greater control over the price and time at which their trades are completed. Now that you know what trading is all about, let's move on to investing. Investing is a method for managing and creating wealth in the market over a longer time span. We're talking years, if not decades. This includes purchasing stocks with a long-term perspective in mind and holding them through market ups and downs until you attain your financial goal or reach the end of your investing time horizon. Many individuals use an IRA, individual retirement account, or 401k account to invest in the stock market to save for retirement. You may well not actively monitor your account every day or even monthly with these types of accounts, nor make modifications to the securities you own. Instead, you'll most likely contribute to them over time, investing and potentially earning returns. You may also invest in a personal investment account, whether through a robo-portfolio or self-directed trading to expand your personal wealth or save for another financial goal such as purchasing a home or traveling the world. So folks, now you understand what is trading and investing in the financial market. But what should you keep in mind? Let's see. Before that, remind yourself to subscribe to the Wealth Moguls and leave a like for this video. So, what should you know about investment technique? When it comes to investing, patience can be a virtue. Successful investment methods typically emerge over time, and as an investor, you may have to wait for several years to get the best potential returns. Therefore, the longer your money is invested in the stock market, your chances of profiting from compound interest or returns are greater. Think of it this way. If you invest $1,000 and earn an average of 7% annually, you will earn $1,070, a gain of $70 after 1 year. After 2 years, that'll extend to about $1,145, a gain of another $75. Keep your investment the third year in the market, and if you earn the same 7% return, you'll be at $1,225, up $225 since you started investing. Thus, compounding lets your profits expand year after year without even increasing your original money. Keep in mind that annual returns vary, and there is no guarantee that you will make a successful return every year. For example, while you may have a 7% return one year, market volatility may lead you to have a negative return the following year. As a result, it is important to understand that all investing activities carry the risk of loss. Patience is complemented by the diligence of sticking to your investments, even when the market is volatile. When news headlines reveal a downturn, you may be tempted to sell your stocks, but making financial decisions based on emotions can be bad for your portfolio in the long run. By avoiding emotional investment and staying focused on the long term, you can ride out short-term ups and downs and perhaps profit from the market's historically upward direction. Diversification is one of the most important strategies for staying calm while investing and positioning your portfolio for future success. A diversified portfolio consists of investments in different asset classes, industries, and geographies to maintain a comfortable level of risk. In addition, by spreading out your investments, you ensure you aren't too heavily reliant on one area in the market. So guys, is trading right for you? Trading allows you to actively participate in the market on a far more frequent basis than investing. If you like the process of researching stocks and are willing to take calculated risks as you navigate the market, you might consider integrating elements of position, swing, or even trading in your overall investment plan. If you want to take control of your portfolio and try your hand at trading to increase your monthly returns, you should open a self-directed trading account with Ally Invest, where you may trade stocks, ETFs, and options with little to no fees. And if you trade wisely, stick to a plan to limit your losses, and succeed in your endeavors, your portfolio may benefit. However, before you begin trading, keep in mind that any short-term trading techniques carry a significant risk of loss, and favorable returns are never guaranteed. It's also no secret that trading, particularly scalping or day trading, may be time-consuming. Active trading involves a great deal of time spent researching companies and stocks, as well as keeping track of and maintaining your portfolio. Having enough time and gaining market experience are essential components of every trading strategy. Ultimately, you may decide that you don't have the time to dedicate to being an active trader. So, what about investing? Does investing in the financial market make sense for you? Unlike trading, investing doesn't require you to monitor your portfolio or the market constantly. Once you've determined your asset allocation and are happy with your regular contributions, you can only need to check in on your account a few times a year to ensure everything is in order. That being said, you don't want to forget about your money completely. Setting a regular timetable for reassessing your portfolio can be beneficial. Investing can also necessitate some heavy lifting up front to ensure that you're placing your money into securities that have a good probability of performing well in the long run. At the same time, returns are never guaranteed. Using fundamental analysis to evaluate a stock's value about the company it represents and the economy can help you make better investing decisions. Long-term investing and trading are two different approaches to achieving your ultimate financial goal. Which method you employ is determined by whether you prefer to invest in the minute-to-minute or even day-to-day ups and downs of the market, or prefer to ride the long-term fluctuations. Neither is right or wrong. Nevertheless, you can make the most of your portfolio strategy by trading, investing, or a combination of the two, as long as you have a goal in mind, a plan in place, and the patience to get there. We hope you understand what the key difference between investment and trading is. So don't forget to subscribe to the Wealth Moguls for learning more, because this channel is all about the financial world. If you have more questions and want to hear something more unique, pop your comment below. Thanks for watching this video. We will catch up in the next video. Bye!